Hi, my name is Zoe and this is my channel Words on Wealth, and today and hopefully every Monday I'll be delivering you 3 things that you need to know about the markets if you're an everyday investor, as I like to say, aka you just want the key takeaways from the headlines to know exactly what they mean for you, your finances and your investments. So if that sounds like a little bit of what you're looking for, then you're in the right place. Let's get started. So first and foremost, we can't go without addressing the escalating tension in the Middle East, which has of course had a huge knock-on impact even over the weekend in which it kicked off, but also at the latter end of last week on the stock markets and most notably oil prices as well. Now, of course, Iran, who is one of the major countries at the centre of this conflict, is a huge oil producer. And whilst countries like the UK, the US aren't necessarily major buyers of Iranian oil, China indeed is, and there is huge concerns about the potential for global supply chain when it comes to oil, but also the Strait of Hormuz, which is a major shipping lane that Iran has control over. In fact, it's huge. A vast quantity of the world's global trade passes through this strait. And if Iran were to decide to close it, this could mean that global shipping, not just of oil, but of all sorts of produce, could be greatly impacted. As a result, what we saw, taking the oil first, is that oil prices shot up. Fears around that global supply chain, fears around Iranian supply chain has really hit oil prices. What this means is that there's usually a knock-on impact as we start to see markets open today and as we start to see investors digest this news. Normally, an increase in oil prices is not good news for the likes of inflation, but also for the performance of stocks, because oil underpins everything we do. It's not just about filling your car up, it's not just about heating your home, it's also about producing raw goods. Anything you buy has had oil in its supply chain at some stage. So if we see the price of oil creep up, then what we'll likely see is also a push up in general prices and therefore a little bit of pressure on inflation. So whilst oil prices have gone up, there's fears around the general global supply chain. Stock markets have seen a bit of a tumble in both their forwards, so what we see are their forward pricing at times when they're not open, but also as they've opened today and they've really started to digest the news of what has taken place over the weekend. On the back of this increased further uncertainty as well, we may also see a bit of a boost in various different so-called safe haven assets. I'm talking the likes of gold, potentially US dollar, and others as well that investors tend to flock to in tougher or more uncertain times. This increased conflict only goes to boost that a little bit further. So what does all this mean then for you and your investments? Well, what it really means is kind of what we know. There's increased uncertainty and all of that has a bit of a dampening effect on investments, some more specifically than others. Oil prices have seen a bit of an uptick, but that in previous times hasn't lasted too long. So let's hold our breath before we leap to any conclusions around inflation or interest rates. So what it means is that as you start to check your investments this week, they may not be looking quite so rosy as they have done in other weeks, but with any luck, both this conflict for the humanitarian side and also for the investing side will be short-lived, and we'll see a relatively quick rebound off the back of it once we understand a little bit more as to what is going on. Next up, in slightly more positive news, we've seen European and British stock indexes hit all-time highs once again last week. The broader Euro Stoxx 500 and the FTSE 100 as well, which is the measure of the 100 biggest companies in the UK, both hit further all-time highs last week on the back of particularly strong earnings reports, notably from the likes of financial services, banks and defence companies as well. This is really positive news for anybody that is in the region, but also for investors who are holding investments in both the European region and in the UK region, as they are seen from an investing perspective at the very least as separate. And this, as I say, is great news for those investors holding investments there. But it's also great news for any investors comparing the likes of the performance of the UK and Europe with the likes of the US. Historically, the US has greatly outperformed the wider European region as well as the UK region. All sorts of reasons for it. What we've actually seen this year is that both the FTSE and the Euro stocks have outperformed the S&P 500, which is the measure of the 500 biggest companies in the US. And lots of investors are pivoting towards Europe and the UK as an investment choice because it's still seen as relatively cheap. When you look at various different metrics that are going on behind the scenes as to how these investments are valued, things look pretty rosy. So what does this mean then for you and your investments? Well, what it really means is that, as I say, if you are an investor holding wider funds, for example, in the European region or in the UK region, then things will look pretty good. And what it means is that we're seeing investors flock towards it, so there may well be a slightly longer period in which these all-time highs last for as well, because more and more investors are moving into the region as they're seen as a good deal, and growth is looking strong and positive. So, some good news to take away for the week as well. And last but not least, the final thing that you need to know about the stock markets from this week is all about China. As we've moved beyond the Chinese New Year, and the domestic spending as a result of it has been a little bit mixed. Normally it's a period of a real uptick for the Chinese economy as people go out and celebrate and spend an awful lot. Actually, the Chinese economy is still struggling to keep up with the targets that it really wants to hit and previous years' expectations and growth as well. What the Chinese government are likely to do is to downgrade their overall economic growth targets. This would take it to some of their lowest levels in the last few decades. Now, it's to be taken with a pinch of salt because the Chinese economy has boomed over the last few decades. It's not to be underestimated how much it has grown. But what this signal sends is that actually China is not managing to quite perform in the way it was before. And this could still have a wider impact on the rest of the globe because at the end of the day, we are all globally interconnected. Not least of which with China, which has been driving the base of a lot of supply chains for many, many years now. If China downgrades their economic growth expectations, what we might start to see is a little bit of fear and worry from investors around the globe that actually things are slowing down and not quite moving at the pace they were before. And things like exports from China may also be a little bit slower and again, not quite as booming as they were before. And I'm saying before as a very broad term there, but really what I'm talking about is think, the last few decades when all we've seen, particularly here in the UK and Europe, is a lot of stickers with Made in China on it, because that is essentially where a lot of goods have been coming from. And China's economy has done very, very well off the back of it. Now, it seems to be that some of that slowing is starting to catch up with them. So what does this mean then for you and your investments? Well, what it really means is that there's just a bit of an air of caution coming from that Chinese side and then into other industries that are greatly impacted by the supply chain from China. So think about things like luxury goods, where there's a bit of a back and forth. Think about any sort of supply chains that depend heavily, be it consumer goods or be it more flexible consumer goods as well, that depend very much on what comes out of China. So what this really means is that people will be watching this, and there may well be a bit of a slowing in certain industries that you could well see in your investing portfolio. It's not necessarily bad news, it's just not news of a whopping great boom still coming out of China. So thank you so much for joining me. Hopefully that has given you a flavour of what went down in the markets last week, what to expect, and what this all means for your portfolio as an everyday investor. Have a great week and see you next Monday. Bye for now.